Hello and welcome everyone. Alexander and Heberman is excited and honored to bring back Mike Becker for today's presentation, Tax Planning, Protecting Your Retirement from Washington. Mike Becker has been in the financial services industry for over 29 years. He started in the financial services industry right off the college campus. After 6 years of running his own financial planning business, he transitioned into sales management. 18 of those years, Mike was a frontline manager located in Minnesota, focused on teaching financial planning to financial professionals. In 2021, Mike decided to start a family financial planning business called Legacy Financial Partners, LLC. Legacy Financial Partners works with Securities America, Futurity First Insurance Group, and Senior Market Sales, providing his clients financial solutions. Mike specializes in building and implementing financial plans for busy families and helping retirees with their retirement income plans. Mike speaks on several different financial topics, including Social Security, taxes and retirement, and long-term care. Mike's recent article on Social Security planning was published on over 250 news platforms. When Mike is not working, he enjoys golf, Wisconsin Badger football, and chasing his 3 kids, all under age 12, around the house, the golf course, and the ball fields. Mike has been married to his wonderful wife, Anna, for 16 years. As always, Alexander and Heberman does not practice in the specialties of its speakers, but welcomes them here to speak for the educational benefit of our clients, friends, and guests. Alexander and Heberman is a specialty firm focused on assisting with Medicare Advantage, supplements, and Part D plans, as well as individual and family health insurance on and off exchange, and ancillary benefits including dental and vision. If you have any questions during this presentation, please use the chat feature at the bottom of your screen and send them to the hosts and panelists. We will respond to them at the end of the session. This will allow anyone who needs to get going to leave promptly at the end and hear the entire presentation. Without further ado, it is my honor to introduce Mike Becker.
Thanks, Brittany. It's great to be back. Thank you for that warm introduction. Great to see a lot of familiar names to those that have seen our workshops in the past. Welcome back, and for those that have not attended one of our workshops, welcome to Tax Planning, Protecting Your Retirement from Washington. Before we get too deep into it, we always need to start with our disclaimer, letting you know that I'm not affiliated with the federal government, IRS, Medicare, or any other governmental agency, nor am I practicing CPA. I am a local financial advisor that focuses on helping people understand what are potential risks and opportunities and planning strategies around that. So as we think about this topic around tax, I love this visual. If you have the ability to take a picture, please do it. There's a few things that could be updated. But as we really think about this tax conversation, it's within the scope of a broader conversation, which is retirement planning. And as we really start to get to that point of retirement planning, there's a ton of things that we have to think about and we have to consider. And so the question becomes, where does taxes fit on this list from 58 to 86? It's really every step of the way is where the impact of taxes comes in. And I think we'll really focus on and help you understand that today. And if you ever Google up great tax quotes, it's all over the place, a lot of partisan stuff. So I have 4 that I like that I think we're going to start the presentation with. And the first one is, I'm proud to pay taxes in the United States. The only thing is, I could be just as proud for half the amount of money. I think we all probably feel that way. Maybe we question some of the things that Washington spends money on, but we believe in supporting schools and teachers and roads and a lot of the infrastructure that and resources that the federal government supports. The next quote says, I'm thankful for the taxes I pay because it means that I'm employed. That's really an appreciation mindset. As much as we get worked up on taxes today, it's always important. There's the other side of that equation. The great philosopher Snoopy once said, Dear IRS, I'm writing you to cancel my subscription. Please remove my name from your mailing list. Now, don't do that, by the way. If you do that, you might end up in jail, but it is a cute way of thinking about how we all probably feel. And then I think this last one I'll hopefully bring back a few times during this presentation. Max Baucus, who's the chairman of the Senate Finance Committee, which is a very powerful committee in Washington, he once said tax complexity itself is a kind of tax. Well, hold that for just a second. Tax complexity itself is kind of a tax. That means, in my mind, there's ways to navigate around it. And for those that are informed, I've always heard it said, there's a tax code for the informed and there's a tax code for the uninformed. So that's why we really have this topic of protecting your retirement from Washington. We're going to talk about some serious threats that are out there when it comes to Washington. And why are there threats? Because we as a country are $33 trillion in debt. If you ever look at the U.S. National Debt Clock.org website, there's a whole bunch of numbers. If you like numbers, it's fascinating. But 33 trillion is the big number. And some of the biggest budgeted items you can see in the middle there, Medicare's 1.6 trillion, Social Security 1.3, defense almost 800,000, but this is what I think is really fascinating. Interest on the debt is almost where our spending is on national defense. What I think is fascinating, if anybody paid attention to the news this week, what happened to the 10-year yield, 10-year government security yield? It's over 5%. We haven't seen that kind of rate in 15 years. Well, guess what? Who's paying that 5%? Our federal government. So that number is dramatically impacted by these higher interest rates. On top of that, there's what we refer to as unfunded liabilities. Those are promises that the federal government has made to people like you and me, that there's Social Security, there's Medicare, and there's other things. You can see on the bottom, those total unfunded liabilities, promises to pay, are over $194 trillion. Where's the government going to find that money? How do they pay for roads and schools and teachers and all the things that we have for social programs on top of all of these things? Well, the federal government publishes what they call the Green Book. And this is Treasury's way of looking at the president's, the budget each and every year and finding revenue opportunities. Revenue proposals, by the way, for the federal government is code for taxes for us. So this is full disclosure out there, and this really is the guidepost for future tax legislation. So it's fascinating because inside this book, this Green Book, are lots of proposals of ways that Washington is looking at generating revenue. And so when we think about that, there's this very real legislative risk. What is legislative risk? That the rules can change. And those rules that Washington change can negatively impact our approach to retirement. Now, it could be flip it the other way. It could be positive, but that no longer becomes a risk. The risk is the changes from a negative perspective. Now, there's some of you out there saying, it can't happen, won't happen. Other of you saying absolutely. And I'm going to share with you later a very real example that we're all living today of Washington changing the rules. And why is that a big deal? It's because it's a tax risk. The risk is that our taxes are going to be higher than planned, which means we're going to have less money to spend. Now let's actually go through an example, a white paper that came out of the Green Book. And there's a lot of words on here. And what I want to point out is what it talks about here under subpart A. It says limitations on high-income taxpayers with large retirement account balances. This is the important part in the paragraph below. To avoid subsidizing retirement savings once account balances reach a very high level. I'm going to leave this up here because this is fascinating to me. 1974, I'll take you back a few years. ERISA was some tax legislation that created the IRA. And the IRA was created under the ERISA Act because there were several Americans who no longer had access to a pension, needed something to save, a vehicle to save for retirement. So at that point, really over the last 40 or 50 years, the government's approach has been, how do we entice and motivate consumers like you and I to save for our futures? And as a financial advisor, obviously, I agree to that wholeheartedly. But this is the first time in the history we've seen the government, Washington, come out and say, somebody's got too high of account balances. And who's going to determine too high of account balances? That's right, Washington. This completely changes the narrative of the way that the federal government is looking at our retirement accounts. Why? Because that's where the money is. Trillions of dollars in our retirement account. So this is a very real threat. And again, we're going to talk about some legislative risk a little bit later. And why is this a problem? Is because this is what we were always told. Tax-deferred savings. On the left side, it says in those working years we were taught we're in a higher tax bracket. Therefore, we should defer taxes to the future. That's what an IRA does. That's what a traditional 401k does. Why do we do that? Because on the right side, the retirement years, we will be in a lower tax bracket, therefore paying lower or less in tax. Where does that thought process come from? I could probably point to a lot of things, but I think it was probably prior generations that maybe went through the Depression, said when we retire, listen, bad things can happen and we're going to save in case bad things happen. I'll just tell you what I see working with a lot of baby boomers. This is not the equation. Most baby boomers I work with, they want to say when they retire, they want to keep the same standard of living. They want to travel, they want to go to Florida, they want to do a lot of great things. They have no interest in lowering their standard of living. So a lot of baby boomers that maybe were thinking that this was the equation are surprised when they look at their goals and what they're trying to accomplish, that this is not the actual equation that they're going to deal with or experience. Now, for anybody that really likes this kind of stuff, maybe I'm assuming not a lot of you are on here that want a whole lot more information, but if you do, these are 3 great resources. I'm going to briefly run through these, and these are great things to take from today's conversation to learn more. And I'm going to start with the middle, which is Come Back America. If you've ever heard me speak on taxes in the past, this is one of the formational books that I read to really help me think about this potential risk that's out there. David Walker, former Comptroller General of the United States, essentially the head CPA of this country, wrote a book. He was a Comptroller General for over, I believe, 10 years. He wrote a book back in 2008, said, we have a fiscal crisis. We are going to go broke as a country unless we do 2 things. Cut expenses in half, double tax rates immediately. That was in 2008, neither of which has happened in the last 15 years. But David Walker's book really gives the math and the story about why we have the fiscal challenge that we have today. That's David Walker's Come Back America. On the left of that is The Power of Zero. I've done this workshop in the past. And what I like about David McKnight's book, he talks about the same fiscal challenges, but he has a recipe for how do we address the potential problem. It's an easy read. It's a great read. Highly encourage that book as well. And the new book that we've been promoting and passing out to our clients is called The New Rules of Retirement Savings. It's an ebook, and it's super easy to read. It's got a little bit of the potential problem, but it's got strategies to deal with the potential problem. So if you're looking for some great ideas, The Power of Zero and The New Rules are great opportunities. You can go ahead and chat if you want the book. Again, we'll give you a chance at the very end to request some of these tools as well. So we're talking about a lot of stuff today. We've already talked a little bit about tax risk, legislative risk. We're going to talk a lot about the basic fundamental concepts that we should probably know when it comes to tax planning. And if you've been in our workshops in the past, we try to accomplish 3 things, right? We try to make this very education-based, what you should know. Number 2, we want to hopefully motivate you. Hopefully you're going to walk out of here doing something a little bit different, learning something, trying to get better financially. And third, we want to provide resources to help you continue to do your planning as well. And so hopefully we will accomplish those 3 things as we go through the workshop. So most of you are on here today and maybe have bits and pieces of knowledge around the tax and tax planning side. It's challenging, and I love this little quote that Lisa Simpson once said. She said, schools don't teach us how to pay taxes because they don't know how to do it either. Who's teaching us this kind of stuff? And when we learn it, the problem is they always say the tax code is written in pencil, meaning it can always change. So it's really challenging for us as consumers to have a good grasp of the tax code, tax planning, and ideas. And so hopefully, again, that's what today's conversation is ultimately about. One of our most highly requested and attended workshops is always something around the topic of taxes. Why? Because taxes are different in retirement. What did we say earlier? Taxes is under the umbrella of retirement planning. Because when we go into retirement, the rules all change. The nature of your income changes from the W-2 every 2 weeks to completely different. Because most of us have heard we have a retirement nest egg. Well, that was probably the old days. Had a pension, Social Security, and a nest egg. Most of us today have a basket of eggs. We have lots of different kinds of investments doing different things. The challenge becomes, which ones do we crack? When do we crack those eggs? And I like this visual for setting up the conversation for today. And it's climbing the mountain and going down the mountain. And there's two phases that we go through in life. We really have the accumulation land. We're accumulating to retirement. And then when we get to the top of the mountain, it becomes distribution land. We're going down the mountain. And what's completely different, so as we're going up the mountain, we're all saving. We're focused on growing assets, right? 50,000 is better than 25, $1 million's better than $500,000, $2 million's bigger than $1 million. We're focused on assets. When we get to the top of the mountain, start going down the mountain, assets don't matter. It's all about income. And it's more than just income, it's about usable income, because you have income, subtract tax, leaves usable income, and usable income means we can go buy things. So this visual really should help us think about the planning, and the ideas and the thought processes need to be looking down the mountain, and how do we really manage and maximize that opportunity. So we're going to go through a couple exercises here. If you have a pen and paper around, pull it out, because this is a great way to get started when it comes to tax planning. And the way we want to start that is think about, where are those assets? And we can take all the assets that we have out there, and we can probably oversimplify them into 3 different buckets. So as we start on the left side, we have the taxable bucket. What is a taxable bucket? How do we know we have a taxable investment? Is because that little investment kicks off what's called a 1099. So your financial institution at the beginning of next year will send you a little love letter saying, you made this amount of money, now you have to pay taxes. What are some common investments that we have there? Savings accounts, maybe CDs, call them brokerage or non-qualified accounts. Non-qualified means they're not in an IRA or 401k. Those are going to be traditional and typical taxable investments. So if you know what you have, go ahead and write it into that bucket. The second bucket some of us might have, probably all have, is a tax-deferred bucket. What is that? It means we are deferring paying taxes on that money to some point in the future. What are tax-deferred investments from a tax perspective? We understand that there's this term that the IRS created called ordinary income. So we'll talk about what the tax rate is for ordinary income, but what falls under the ordinary income category in tax-deferred, the most common are going to be traditional IRAs, 401ks or retirement accounts, 457s, 403bs, et cetera, pensions or lump sums. Those are going to fit into the tax-deferred bucket. So again, if you have those, write those all down in that bucket. And the values is helpful too. The third bucket is tax-free. Those are going to be your Roth accounts, a Roth savings, a Roth IRA, Roth 401k, Roth conversion, health savings accounts, cash value life insurance, maybe municipal bonds. Those are going to be common themes or products that we're going to put into that bucket. So this is a great way to start to figure out where your assets are from a tax perspective: taxable, tax deferred, and tax free. That's climbing the mountain. How about going down the mountain? We need to look at that equation as well. So instead of buckets, we're going to use spigots. So again, play along, have 3 different spigots or 3 different buckets. Write down where your income is going to come from in retirement. On the left side, we have that term I referenced earlier, ordinary income. What does ordinary income mean? Well, your friends at the IRS and the federal government created it, said, okay, what's under that category? Employment, whether it's self-employed or working for a corporation. Pension income, qualified plan and IRA withdrawals or distributions, interest on savings, we talked about that a moment ago, and short-term capital gains. Those are going to be common income streams in the ordinary income category. In the middle, we have tax favored. Tax favored is not tax free, it's tax favored. It might be a little bit better off from a tax perspective than ordinary income. What are going to be common income streams in the tax favored? Social Security, long-term capital gains, and qualified dividends are going to probably be some of the more common tax favored investments we have in the middle category. And on the far right category, we have tax tax-free income. And those are going to be incomes that come from Roth accounts. Remember, we still have to make sure that those Roth accounts have been established for 5 years. Roth IRA, Roth 401k, Roth conversions, health savings account, cash value life insurance, we call them LIRPs, and municipal bonds. So if you have those things, write those things in that category. So those two slides help you understand where your assets are and where your future income is going to come from and where you're going to be sitting from a tax perspective. And so we're just getting started here. There's a lot of other decisions like we had in that first chart that you have to make. You have to make decisions around Social Security, and you have to make decisions around pension and capital gains, and we're going to start to introduce these terms around RMDs, and we've talked about Roth accounts and deductions and Medicare and on and on and on, and it makes us want to go crazy. I love this little cartoon. It says, I only need for a few hours. That's probably us. When we think about taxes, maybe it's your tax accountant that has to deal with us in these issues, but the point is what we've already covered is going to make us nuts. What we're going to continue talking about is probably even more challenging. What we're going to continue to talk about are things that we feel are very relevant to, again, planning for taxes. The first two terms that I want to make sure that I introduce are effective tax rates and marginal tax rates. So when people say, what's your tax rate? There's really two kinds. Effective tax rates is simply you take your income, let's say it's $100,000, and how much did you pay in tax that year? It's called $10,000. Divide that by that number, tells you that your effective tax rate is 10%. You often will find that number in the back of your tax forms to tell you what your effective tax rate is. What's really important for today's conversation is this term called marginal tax rates. And really what this is I think about this as last dollar earned, what tax rate is it taxed at? And to help communicate that concept, this really helped me many years ago, is this concept around a beaker. So for those of you who have a great science background and chemistry, you love the beaker. And what do you think about the beaker? You put something in, it goes to the bottom of the beaker. So in the context of today's conversation, you put income in, drops to the bottom, and a portion of your income gets taxed at 10%. Everybody has a portion of their money taxed at 10%. Even Bill Gates and Elon Musk have a portion of their money taxed at 10%. Even though it's only 10 seconds, a portion's taxed at 10, a portion's taxed at 12, 22, you get the point. So that's what you want to think about in this concept of marginals. If you put more money into the beaker, it flows and you are taxed at that according rate. And you can see a tax table to the right. We'll talk about that in just a moment. Okay, so again, marginal tax rates really important as we start to talk about a lot of the concepts we're going to talk about today. The next concept I want to really reinforce is this concept around bracket jumping. So here's a tax table for a single person. And you can see 10 through 37, not necessarily important. What I really want to take your eyes to are those arrows. The jump between 12 and 22%. What jump is that? That's almost 100% increase from 12 to 22. How about from 24 to 32? Almost over a 30% increase in my tax rate. These are a really big deal, and understanding where you're at on the tax map allows you to potentially take advantage of lower tax brackets and understand when you might jump into a higher tax bracket. And that's really important as we start to get into this next phase of today's workshop, talking about some unintended consequences. Here are the numbers for married filing jointly. Again, what I want to illustrate is the bracket jumping. Same rates, just different taxable incomes on the right, but same concept. 50% increase, over 30% increase as you jump brackets. Okay, so you're probably thoroughly confused. So is everybody else, and that's okay. And I love this little quote because it says, none of this makes any sense. It's almost as if they don't want me to understand. This is a tax code. This is not my workshop. And the person on the right says, maybe that's why they call it the tax code. What did Max Baucus say earlier? Tax complexity itself is kind of a tax. But where it starts to really get confusing is these hidden interactions, these things that are landmines, if you don't understand what they are, it's super hard for the average person, even well-trained financial advisors, to proactively navigate these things. Sometimes they change, but because there's so many moving pieces, in many cases, these moving pieces become additional taxes, even though it doesn't fall under a traditional federal tax rate that we just went through the tables. And so the four most common hidden interactions that we're going to talk about today are capital gains, Social Security, Medicare or health insurance premiums, and required minimum distribution. So we're going to go through each of those. And we're going to start out with capital gains. So what are capital gains? Capital gains is really, it's the way for the federal government to promote public policy. If you invest in things, you're going to get a slightly better tax rate. You invest in homes, you invest in property, you invest in businesses, you invest in things, then you are rewarded with a slightly better tax rate. And we remember when we talked about incomes, this is tax favored. So you can see if I go down the married filing jointly column, it says anybody making up to about $89,000, if they have capital gains, that capital gains rate is 0. That's better than 10 or 12, right? Somebody who's making $500,000, who might be at a 35% federal marginal tax rate, right here in the cap gain side, is only 15, right? That's a pretty good tax favored deal for some people. So capital gains is one of those really interesting plays, but that's a function of your ordinary income. Okay, so that's an example number one. Number two, I want to come back to this concept that I talked about earlier, legislative risk. Can Washington change the rules? And again, some of you are saying, absolutely they can. Some of you are sitting there saying, nope, they can't and they won't. I want to share a very real example that impacts all of us. And I'm going to take you back to 1933. What happened in this nation's capital is we created the Social Security system. And at that time when Social Security was created, Social Security benefits were designed to be tax-free. Not only in 33 when it was created, but it was also reinforced by the Treasury in their rulings in 38 and 41 that effectively said, listen, we are explicitly excluding Social Security from federal income tax. How it was set up, Treasury rulings, then what happened? 1983, federal government passes the Social Security Act. I believe this was during the Reagan era, not that that necessarily matters, but 1984, what happens? A portion of your Social Security is now subject to taxation, which is going to go to the chart I'm going to show you next. So again, what was promised as tax-free was reinforced as tax-free. The rules changed. This is what I refer to as legislative risk for a lot of those consumers. So let's talk a little bit about how is Social Security taxed. Now, most of us have heard about all these different kinds of incomes, right? We've heard of gross income, net income, adjusted gross income, modified adjusted gross income, on and on and on. Let's add to that list provisional income. Why does provisional income matter? Because it's this little chart here that was created back in 1984 that said a portion of your Social Security benefits might be taxable. Let's look at the far right column. How much of your Social Security might be subject to taxation? 0, 50, or 85%. Now I want to make real clear here is the tax rate is not 50%. The tax rate is not 85%. Of the Social Security benefits, a portion of it's subject to taxation. So as we're all looking at that saying, it's horrible, it's terrible, I'd like to spin it the other way and say, still 15% tax-free, still potentially 50% tax-free. Remember that middle spigot, tax-favored, is still where Social Security fits. But the provisional income columns you see, one's for single, one's for joint. Let's go through joint. So if I have less than $32,000 of provisional income, right? We have to understand provisional income. None of your Social Security is taxed. If your provisional income's between about 32 and 44, 50% subject to tax. Over 44,000, you see the point. Here's what I think is fascinating about this chart. This chart was put back in place back in 1984. At that time, very few people actually had their Social Security benefits taxed. The last I saw, now let me back up, this chart has not changed. A lot of tax charts index with inflation. This does not. So a lot of people that didn't fall into that category, inflation has taken incomes higher and got, now what? I think last study I saw, 62% of Minnesotans now pay taxes on their Social Security. And that number is going to go higher and higher if they don't index this. That's an example of what Washington can do to put a little something in place that becomes quite punitive 30, 40, 50 years down the road. So the question becomes, how do we calculate provisional income? It's actually a pretty straightforward equation. You take half of your Social Security benefits, basically add everything else. All your wages, self-employed, working for a corporation, any pension income, interest you receive, qualified plan, IRA distributions or withdrawals, any municipal bond interest gets added back in. So that's how you figure out your provisional income. So again, fascinating where the government or Washington can change those rules and have changed those rules. Okay, let's keep rolling. I'm sure everybody's excited at this point about what's happening with the tax code, the potential pitfalls and challenges. So some of us have done a great job saving. I think this is a cute cartoon too. It says, no, you can't deduct what you spend on lottery tickets as retirement planning expense. Some are using the lottery as part of our retirement planning strategy. Some of us have saved well. And so we've saved well in traditional IRAs and 401ks. And most of us know in those traditional IRAs and 401ks, we can't really get the money for the most part until we're age 59 and a half. Well, now a bunch of people get to 59 and a half and they understand pulling money out of that IRA, they have to pull it out as ordinary income, put that in the beaker, right? So now their marginal tax rate is fairly high. So they say, whoa, 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 I don't want to take any money out of my IRA. Federal government says you don't have to take it out at 59 and a half, but this is not tax deferred in perpetuity. At some point, you have to pay the piper. And you have to pay the piper through a little term called the required minimum distribution, or RMD. There's a number of numbers here, but essentially what it says is when you get to a certain age, the IRS says, listen, you have to take money out. Well, you don't technically have to take money out, but if you don't, there's a penalty, a stiff penalty that's associated with it. So there's incentive to pull money out of RMD. And we're going to talk a little bit about how you calculate RMD in just a second. But let's talk about a couple changes that have happened to RMDs here in the last couple of years. And it's the Secure Act, we've heard about that, and the Secure Act 2.0 in the last few years. Essentially, it took that RMD date, forever it was 70 and a half. Now some people have a 70 and a half RMD, some have a 72, some have a 73, and many of us will have 75. Figure that one out, right? The point is, it's not quite as simple as if you hit 70 and a half, you have a required minimum distribution, but it is as simple as saying when you hit RMD, you must take money out of your IRA in retirement accounts. And you can see the penalty was reduced as well. So how do you calculate required minimum distribution? It's actually a pretty simple formula. You have your account balance on December 31st of last year, divide that by an expectancy factor. It tells you how much you have to take out this year. Pretty simple formula. So figure out what your balance was on December 31st. Here's a table that you can reference. There's a couple different tables, but this is what I want you to focus on here is what's happening in the third column from the left, the percent equivalent of the balance. So it's 72, you can see what the equivalent is. 82, 92. What's happening? The percent of your retirement account that you must take out is increasing fairly dramatically. Whether you want to or not, you need to take that money out. And what I tend to see with a lot of 70-year-olds at that point, or 72-year-olds, is they've already got their spending habits established. So pulling a bunch of money out of their retirement accounts, they know there's different options. And the first option is they can spend it, but a lot of them don't. Because again, their spending habits have been established. So to back up, what can I do, or what do people do with their required minimum distributions? They can spend it. Again, a lot of people don't. So what do they actually do? They put it into another investment. If we go back to our buckets, the only one they can probably do is the taxable bucket. Or what do most people do is they put money into their taxable bucket, which creates more 1099 income, which creates more tax. So that's option number 2, and that's often what happens. Number 3 is you can do some more financial planning. Smart people often will say, okay, well, how can I use some of those dollars to protect and build my estate? So one thing that people often do is look at things like long-term care insurance, protect their estate versus at risk. Some people look at life insurance because that's a way more efficient wealth transfer to humans. IRAs are terrible distribution, we'll talk about that in a minute, to kids, great for charities. And the last one, I'm going to come back and talk about this at the very end because this becomes a really good opportunity for those that are over 70 and a half, this concept called a QCD or qualified charitable distribution. So we'll talk about that in a little bit. But let's jump back to RMD here. So here's what happens in the real world. So we have an example here of somebody who is receiving $80,000 of taxable dollars. And so you know where they're at in the chart. They're in the 12% tax rate. Well, based on their age and their IRA size, which you can see is a touch over $500,000, their RMD that calendar year was about $20,000. So what happens? That $20,000 goes into the beaker, right, on top of the 80. So now look at the chart. Where does $100,000 go? It goes to the 22% marginal tax rate. What did we say earlier? From 12 to 22. A portion of that money that comes out of their RMD or out of their IRA is now paid. Now they're paying tax at almost twice the rate from the 12 that they're paying on all their other income. So this happens over and over and over as those RMDs, we talked about bracket jumping. Often RMDs force or make bracket jumping happen. So let's talk briefly about RMDs. Penalty was reduced a little bit with the Secure Act. You may withdraw any amount or an amount above RMD, so any amount, but the excess that you pull out, let's say in 2023, you can't roll it forward into future years. That's a distribution for 2023. You'll have a new RMD number for 2024. You pay taxes as ordinary income. As we said, put the money into the beaker. Number 4, RMD amounts will vary from year to year. Why? Because it's based on 2 things. 1, account value, December 31st. 2, expectancy factor is going to change every year. Number 5, a lot of mistakes. If you are married, understand that you can't combine distributions. Husband can't take out more and say, I'm satisfied and I'm taking enough out to satisfy my wife. IRAs are individually owned accounts. Husband has his RMD requirement. He has to pull out of his IRAs. Wife has her RMD requirements. She must pull out of her IRA. Very, very important. Okay, let's talk about this IRA transfer I mentioned earlier. There's a terrible wealth transfer to kids or to other humans. IRA transfers to charities is another story. So there's been some changes in wealth transfer and presumably will be more. The 3 things I wanted to highlight here is the stretch. If you are planning on the stretch rules, which essentially allows the kids or the beneficiaries to stretch distributions from that IRA out over their lifetime, that's gone away. Beneficiaries, by the way, this is just something that most of us should update periodically. Too many people set and forget their beneficiaries. If you have the estate or none, you should really look at changing those beneficiaries to trusted people. And then number 3, IRAs to the next generation. The kids still have to report any distributions out of your IRA as their ordinary income. Let me give you an example. Your daughter, her household is middle American. They have $150,000 of income coming in, taxable income, and they inherit $500,000 from their parents. So some people will take all of that money out in distribution in year 1. Must take it out between 5 and 10 years. 10 years is really the rule today. But a lot of people take out their distributions in year 1. So now think about my beaker concept. Now that $500,000 goes into the beaker. Now they go from 22 probably to 35 or 37%. 37% of $500,000 IRA, inherited IRA, is a lot of money to be given to the federal government. If David Walker was right, and he said tax rates have to double in the future, say 35 goes to more, 50. Just imagine how much of your IRA could go back to Washington because somebody has to pay ordinary income tax. Okay, moving along quickly here. Then we have health insurance, very big deal. So we have two parts of health insurance. We have under 65. We know we need health insurance under 65, and there is a premium cost. Well, what's offset are what's called APTC, or advanced premium tax credits. And think about this as the government's way of reducing your health insurance by giving you more tax credits. And you get more tax credits, why? Because you show less income. Or another way of looking at it, if you make a whole bunch of money, you're going to get fewer of those advanced premium tax credits. So again, understanding this is a potential tax for people. That's a hidden interaction that we spoke about earlier. So that's under 65 health insurance. How about over 65? We call that Medicare, right? Now understand this chart is 2023. We've rolled out new 2024 tables here recently, so they're a little bit different. But what I want you to understand is the concept of what's happening here. So if we have an individual that's making less than $97,000, you can see on the far right side, that is their Medicare contribution number. What if they make more? Guess what? Government says, well, you get to pay more, you get to contribute more because you have more income. I consider that a tax. That's a hidden interaction that's out there for those of you and those of us that have saved well and have a little bit more income in retirement. Again, hidden interactions. Health insurance under 65, health insurance over 65. I can't help talking about IRAs without talking about what can destroy an IRA quicker than anything else is the cost of long-term care. We do have a recording that we did, a couple recordings. You can chat if you'd like this, but we've seen a number of different statistics out here. Taxes don't matter if there's nothing left. And if there's nothing left, because the tremendous costs of long-term care. And we ask people all the time, if you had a choice of leaving that IRA to the government, to the nursing home, to the kids or charity, whom would you like to leave it to? And it's rarer, if ever, the government or the nursing home. Really important for us to make sure we take a look at. So some strategies. We don't have a ton of time to talk about all the different tax planning strategies. I'll talk about how you can get a little more information in a little bit, but this is my key takeaway for tax planning strategies right here. On the left side is what the typical person looks like. They have a big circle, a lot of money, in IRAs and 401ks, and they have a little circle in tax-free. Let's go back to our buckets. Are your numbers like that, where it's dramatically different? Well, that's where a lot of us are. Well, what we got to do is we got to invert that. We got to have a smaller bucket of tax deferred, and we got to look at getting more into tax-free. And there's strategies for doing that. We run tax reports for clients, so this is something we'll talk about later. If you'd like a tax report, we can help, but this gives you an example. We have the client in the middle there. It says no planning done, and their ending portfolio value is $640,000. That's compared to the planning strategy on the right, where we did some tax planning, and 100% of that was tax-free, and the ending value in the portfolio was a little over $1 million. So let's call that about $400,000 difference by doing some tax planning, which on that right side. So these are reports we do, the kind of work we do for clients as well. Earlier I spoke about the power of zero. If you pick up this book, it will reinforce these are typical strategies, and you want to use a combination of these, but take advantage of these different opportunities to put yourself in a position to have more tax-free, the buckets that we just talked about, but more importantly, as you're going down the mountain, you have more tax-free income. Okay, as we start to wrap things up, I told you I wanted to talk about QCDs, or qualified charitable distributions. Why? Because as we're ending the year here, there's a lot of you sitting out there that are over 70 and a half and have yet to take your RMD. So if you're over 70 and a half, you've yet to take your required minimum distribution, and you're charitably inclined. So if you fall into those three categories, make sure you're paying attention here to the next slide. The QCD is a tremendous opportunity for you. And what is the QCD? Again, qualified charitable distribution. What is it on the left side? It's for somebody who's charitably inclined, right? If you don't care about charities, you give nothing to charities, this is probably not something you're going to take advantage of. But many of our clients have some kind of charitable intent. Number two, it's a direct transfer from the IRA custodian directly to the charity. We're going to talk about this on the other side at the bottom. Mistakes are made with number 2. It's very clear how you're able to do a QCD. Number 3, that transfer from the IRA to the charity satisfies the required minimum distribution. If you go back to the example of the client needing to take out $20,000, well, let's just say in theory, they moved $20,000 from their IRA to a charity, they'd have $0 that they'd have to take out for a required. They have a report, which is the next one. That money is excluded from taxable income. They still have to pay only $80,000 versus being bumped up into that 22% tax bracket, marginal tax bracket. And some of us ask, well, what if we don't itemize? It doesn't matter. You can still do the QCD. Now, can I make a QCD on the right side? You have to be 70 and a half. Not just the year you turn 70 and a half, actually 70 and a half. The maximum you can contribute is $100,000 per person, husband and wife. Not a problem for most of us. And the funds must be transferred from the IRA within your RMD deadline. For most of us is December 31st. And again, that last note, be very cautious. If you take money out of the IRA, put it in your pocket, you're taking it to distribution. And then you take it from your pocket and send it over to the charity. That does not qualify for QCD. So very clear, it needs to be from the custodian of the IRA directly to the charity. Okay, so let's help map this out as we've gone through and mentioned several times in this conversation. This is some challenging material. This is tough stuff to wrap your head around. And then again, to really understand some of these pitfalls or landmines is very, very challenging. So what are some resources we have to help support? Well, the New Rules of Retirement Savings is an ebook that we're happy to send out to anybody that requests it. So we'll give you a chance to chat those if you'd like this material. If anybody wants one of our tax reports, a distribution and conversion report, again, it shows your current strategy and then proposed strategy, how to have a little more tax-favored distribution strategy. It looks something like this, where it tells you how much you could potentially convert and utilizes things like bracket jumping to make sure you're making smart decisions. So these are a couple resources. So the other thing, and I get this question a lot after my workshops, is people often say, well, Mike, what can I get from a complimentary conversation? What does that look like? Well, it's really whatever's on your mind. And so it's a chance just to ask questions. Maybe it's some questions from this particular workshop. Maybe it's from a former workshop, but really it's wide open on the topics that we can talk about. Number 2, we can talk about the strategies. Maybe strategies you're looking at, maybe other strategies that might work in your situation. And number 3 ties along with that is maybe about some ideas. Mike, I was thinking a little bit about this or thinking about that. We're happy to help as well. Some people want to know what our services are and how we can potentially help. And then again, it's wide open. So again, resources, if you want any of these resources, feel free to chat. You can just chat a number. You can make it super easy. If you want a consultation, want us to reach out to set up a time to have a brief conversation, just put 1. If you'd like the ebook that we talked about, the New Rules, you can put 2. If you want some kind of tax reporting, 3. And if you want a recording of this workshop for yourself, or you want to send it to somebody, by all means, take advantage of the recordings that we have. And again, feel free to chat what you would like if you would like something, or if you don't feel comfortable chatting and prefer to just send me an email, you can see my email, mikebecker@ffig.com. Whatever is easiest for you. Again, we'd love to have and provide whatever resources we possibly can. And I'd like to congratulate and thank everybody for being on this call today. This is a hard topic. I can go on for hours on this topic, but one of the smartest people on the planet once said the hardest thing to understand in the world is income tax. And it's only got progressively worse since this person was alive, but I think that says a lot. So as we start to really wrap things up, I want to thank everybody for their support of attending our workshops and asking questions and follow-ups and recommendations for topics. I also want to thank Brittany, Joshua, and the team for the opportunity to be here as well. They take a lot of time, energy, and resources to put these things on. So I want to thank them. But more importantly, I want to thank you all for the opportunity to be here. And hopefully you've taken something from our workshops and put yourself in a better position. Feel free to chat and celebrate what you've done in the past as well. We love to hear that positive feedback. So we're going to go to Q&A here in just a moment. Here's my contact information for anybody that needs it. And then I'll flip back to resources here in a second. We're going to flip it out back to the Q&A here in just a second. But again, thank you, everybody.
Mike, thank you so much. Wonderful information as always. As we transition to our question and answer, just want to remind people that you can put questions in the chat feature under hosts and panelists, and I will get them here and make sure to relay them to Mike. Also want to remind people that if you want access to this after the fact, I know Mike just mentioned this, but you can always email him or us at workshops@mnhealthagents.com to get a copy of this recording as well. So to begin, we are wondering, the first one is, how would I go about getting a tax report, and is there a fee associated with that?
Good question. The tax report, you just put in number 3 into the chat or email us. What we'll do is we'll just send you some basic information that we need in that situation. And if it's fairly straightforward, we'll just do it and send it to you. If it is fairly complex, we'll let you know, like the simple free version. But if you want a more complex, we'll let you know if there's a minor cost to that. But if it's simple enough, we can just go ahead and send it off to you.
Okay, great. Someone asked, why isn't my accountant talking to me about these things?
Because they're too busy doing taxes. I mean, that's part of it. Because when do we typically call on our accountant? In February, March, and what is their world like? They're trying to spit out tax returns. So that's probably the biggest reason. But I think the other part of this, and this is not to knock any accountants, because there's certainly a lot of accountants that are trying to do some of these things. But a lot of accountants, if you think about it, they are hired to do what? To help us pay the least amount in tax today. And so a lot of our strategies are how you're going to pay more taxes today. Right? It's the opposite. But we think about, if you're driving in a car, they tend to be looking through the rear view mirror. Here's what happened in 2023, and trying to make those decisions on how do you pay the least amount of tax today. Whereas financial advisors, Brittany, we're looking at 10, 20, 30 years down the road and say, how do you pay less in tax over your lifetime? And so it's just a different view of how you do it, but it's also what we're hired to be forward thinkers, where again, our CPA friends are hired, their job is to help you pay as little in tax today as possible. But I think there's a lot of accountants, if you ask about a lot of these topics, they would definitely take the time. They're just not going to do it in February, March, and April.
Sure.
Talk to them in June and July.
Sure. Sounds good. How do we know if we should continue doing what we've always done? Sounds like they're referring to tax deferred and whatnot, or whether we should be using a different strategy.
That's always a hard question to answer. I think the most general answer I can give is the answer to this question will probably tell you. Do you think you'll be in a higher tax rate environment in the future or a lower tax rate environment in the future? If you think you're going to be in a lower, continue doing what we're doing. Like you said, the tax deferred strategy, Brittany. If you think you might be in a higher tax bracket, then you should look at some of these alternative strategies, the power of zero and the ebook that we had, the new retirement rules. All those things help you understand a different thought process, because we've always thought the other way, that we're going to be in a lower tax bracket. And again, a lot of us, my boomers, they don't want to be hunkering down. They want to travel. They want to do a lot of fun things. They have a lot of goals. So they're more concerned about the risk being higher than the risk being lower.
Sure. Makes sense. Following today's meeting, what's the first thing we should do to get a handle on our tax situation?
Sure. And that's the hard part is, again, referencing, I could have probably been talking for hours on this topic and given a lot of tactical ideas, and we've certainly done that in the past. But I think those two, the 2 pages I referenced, the buckets, writing down what accounts you have, and the values gives you sort of a baseline and a visual to see. I think that's a really simple way to start. Number 2 is the income page. Where is your future income going to come from? And again, it gives you a really good visual picture, a very simplistic visual picture is the place to start. That's number 1 and 2. And then number 3 is going back to now adding those categories up, because I had the pictures of the bubbles, right? I had like the big bubble, which is the tax deferred, and add the little bubble that's tax-free. So understand where your bubbles are, and then try to flip those bubbles. So how do you now move from all of that tax deferred money to start building tax-free? That's where I believe The Power of Zero is a great book. We had that slide that had 7 or 8 different tactical things that people could be doing. But take advantage of building on those wonderful tax-free tools that are out there. Roth IRA, Roth 401k, Roth conversions, LIRP, HSAs. Start doing those things, and you're going to start to flip the size of those bubbles.
Great. And you talk about the slides. Are the slides available to people after the fact?
You can request those. Let's make that number 5. Or write slides. Happy to send that. The recording, of course, is available, but if you want the slides, absolutely.
Sounds good. There's so many things to think about in retirement, obviously. Is tax planning a high priority in your perspective?
I think that's a fascinating question because, as we said, tax planning is a part of retirement planning. And where do you focus on? Where do you focus? What's more important? I don't know if anything is more important. I probably do have an opinion on that. But I think tax planning is underappreciated. I'll tell you where I see a lot of people make mistakes, Brittany, is some people really focus. There's this trend of focusing on what's my expense in my investment. Okay. 75 basis points is too much compared to 65. They're really in the weeds on a few basis points. And I'm not saying you don't look at that stuff. But when we can talk about maybe a third to a half of our nest egg could go in the form of taxes, I think there's too little emphasis put on this conversation today of the tax risk. So what I would say is all of it's important, but don't sweep the tax conversation under the rug. This should be part of it. And again, what we get to see every day is all those hidden interactions. And so having strategies around mitigating some of those risks in the future is really important. Sure.
Yeah. I mean, it makes sense. If you're looking at a 1% difference on a fee in an account versus, 10, 20, 30% difference on taxes, it comes into play.
Big time. And you see a ton on the health insurance side, right? Health insurance and Medicare is, boy, if people can just, because they jump into those other brackets, again, that's tax. If it's another $50 a month or $100 a month, add that on to the tax burden.
Sure.
Right? So this is a big part of the conversation.
Referring to the income-related monthly adjustment amounts, the IRMAs. Yep, absolutely. I like my financial advisor, but she doesn't talk about this stuff. How do I get advice on this without having to give up my current advisor relationship?
I think that's a fantastic question because I think a lot of times people do have relationships with financial folks. Right? It could be accountant, it could be financial advisor, insurance people. You don't have to give those relationships up. You just have to find somebody who can slide in next to you to be able to do those type of things. And I think that was one of the first questions is, well, that was a report, but there's people like me out there that do financial planning that you don't have to move all the assets over. We have the ability to build a financial plan for people, charge a particular fee, and then the consumer can go implement that. They can go work with their financial advisor to implement the strategy. So we and others that are in a space that do financial planning for a fee complement those relationships so they can keep that person in place.
Wonderful.
Good question.
Love it. This one's a little specific. It says my planner is Jonathan, starts with a B, Benji maybe? You have presented for him before. Do you work together?
Jonathan B.
B-E-N-G-E.
Don't recognize the name.
Okay. Maybe we'll have to take that one offline.
Yeah, reach out to me directly on that question.
Sounds good. All the income brackets you described federal limits. So would they not vary state to state?
Yeah, we really kept today's conversation focused on the federal piece of it. Obviously, there's a state component as well. So they don't line up perfectly with the federal brackets, but the more punitive is going to be the federal side. That's why we scrunched a lot of information in 50 minutes. So getting to the Minnesota side is, again, a whole lot more too. But I think if we focus on really managing the federal side, you're going to be then managing the state side pretty well too.
Well, not to mention, while the majority of our clients and friends are in Minnesota, we do have people just across the border in Wisconsin, or, you know, snowbirding, or in other parts of the country that just got connected to us one way or another. So for the sake of time, it's probably best to focus on the more applicable. So the next question is, can you put the required distributions into a Roth?
You have certain Roth contribution limits, right? So that becomes, if you're over 70 and a half, I'm assuming you are not working anymore. And if you're not working anymore, you can't do a Roth IRA. You can't put new money into a Roth IRA. But what you can do is you can do what's called a Roth conversion. And so the Roth conversion flips money for your IRA and puts it over into the traditional IRA. So let me back up though. So there's ways of getting more money into the Roth IRA. But taking money specifically through the RMD and then moving into the Roth, you always have to take that money out of the IRA and pay taxes on that money. Now, again, you can't stuff that money if you're not working and have earned income into a Roth IRA, but you could use that money to potentially pay the tax on a Roth conversion, because there's no age limit on doing Roth conversion. So mechanically, what we're basically saying, or I think the question is can you get more into the Roth IRA, especially if you're over 70 and a half? You can, and it's usually through the form of a Roth conversion.
So that makes me think of two potential follow-up questions.
Yes, ma'am.
One is, if someone is working after 70 and a half and they had to take a required minimum distribution from a traditional, could they take it and put it into their Roth?
Well, remember, and I want to be clear on this, taking it and putting it in, you have to take receipt, right? We have required minimum distribution, you are paying taxes, right? We talked about that. You have to pay the piper. So you can take it out. What you do with that distribution is up to you. We talked about the 4 examples, right? So number 2 was save it. So you could save it into several different things. There's fewer options at 70 and a half. But now you've got the example we used of 20,000. Now you've paid taxes on it, you have this 20,000. Now you can do several different things with it. If you are working, you could do a Roth IRA contribution for you and your spouse if you're married.
Okay. And then the other question that it makes me think of is, if someone did a Roth conversion after they have required RMDs, would that count? Would the conversion count as an RMD?
Good question. Great question. No.
Okay.
No.
I had a feeling that could follow. All right. And I know a number of people have put down the numbers and what they're interested in. Thank you so much. We're taking note of that, and we will make sure to get those out to you. If there's any other questions, please let us know. Otherwise, once again, I want to thank you, Mike, for being here and providing such amazing information for us and our friends and clients. And I want to thank everyone who has attended both this session and our previous ones this year. Obviously, we are in our busy season now at Alexander and Haberman as we try to help people with the annual enrollment period and the very shortly upcoming open enrollment period. And so we're happy to help in any way we can, but just want to thank you again for being here, and thank you everyone who's attended. Don't see any last minute questions coming in. So just want to say again, this was Tax Planning, Protecting Your Retirement from Washington. And as always, our workshops will be available on our YouTube channel. You can also request a recording of this or any of our previous workshops by emailing workshops@mnhealthagents.com. Alexander and Haberman is a specialty firm focused on assisting with Medicare Advantage, Medicare supplements, and Part D plans, as well as individual and family health insurance, on and off exchange, and ancillary benefits, including dental and vision. Thank you very much.